to the top line, which is your sales or your revenue, how do we decide when to recognize that revenue? See, in the old days, what we had was something called cash based accounting, right? We don't have that anymore. Maybe some small shopkeepers might be doing it, but any company with a decent amount of business is not going to be doing this because it's not allowed under the financial reporting standards. What we have now is accrual based accounting. And what is the meaning of this word accrual? See, let's say this is you and this is me, and I buy something from you. Let's say I buy your car. I buy your car. Now, I haven't paid you for it, but I take your car. This is your car. I take your car and I drive away with it. And I haven't paid you as yet. The question is, have you sold your car to me? You've given me the car, I've taken it, I've driven away with it, right? I've agreed to pay you. We've agreed on the price, and I've just requested you that I will pay you later. But the question is that is the sale done? Can you record the revenue that, okay, I have sold this car for $5,000 to Mr. X, right? Is this sale valid? The answer is yes, because the delivery is done. The delivery is done, right? You've given me the possession of the vehicle. I have accepted. So the customer has accepted, right? The risk and reward of the car has transferred to me, which means if there is an accident, it's my problem now. And if I'm enjoying the car, the reward has also transferred to me. So there are other rules as well, but I'm just giving you a big picture over here that revenue recognition does not depend on the payment of the sales. It doesn't depend on cash. Cash could, or maybe let's say you haven't given me the car yet, right? But I have given you the advance. So can you record that sale? The answer is no. Just because I have given you the payment in advance, you cannot record that sale until you do the delivery, until I accept the delivery, until the risk and the reward of the asset has transferred to me, the sale cannot be recorded. That means the revenue recognition is linked not necessarily when the cash is received, but when the revenue is earned. So you as the seller and me as the buyer, right? It has absolutely nothing to do with when the cash is being transferred to you. It could be coming afterwards, it could be coming before. It has nothing to do with that. What is more important is when have you earned this revenue, which means delivery of the asset, right? Acceptance by the customer, the transfer of risk and reward. And there are a few other things, of course, we will go through that list. But the general concept here is that the consideration for whatever product that or service you're giving to me should have been done. As a buyer, I should have gotten the benefit against which you are either hoping to receive cash from me or you have already received cash from me. So if you have already received from me, it doesn't matter. If you are going to receive later from me, it doesn't matter. The point is the sale will be valid once you have given me a certain material benefit of that product or service, and that is when you can record the revenue under the accrual method of accounting. Right? And we're going to go through multiple examples so this becomes very, very clear for you. So let's take the simplest example. If a company sells good for $100 cash in period 1, can it recognize the revenue in period 1? And it has sold the goods. The goods have been transferred, right? So the answer is yes, of course, because you sold it in period 1, you can record that revenue, irrespective of whether the cash has been received or not. Now let's make it a little more complicated. So let's say a company has sold the goods on credit, which means payment has not come in. but the goods have been sold in period 1 and you are expecting to receive the cash in period 2. Now the question is, can you as the seller recognize the revenue in period 1? You have already made the sale, which means whatever is the requirement of sales, which is transfer of risk and reward, delivery done, customer acceptance done, all of that is done, but payment hasn't been received. It's on credit. Payment will be received in period 2. So can you record or recognize the revenue in period 1? Yes, you are right. You can record the revenue in period 1 because you have completed the sale, and even though it's on credit and you will receive the cash later, but the sale has been done and you will record it as accounts receivable. So on your asset side and on your liability and equity, so this is your company's balance sheet, what will happen is, let's say you first produced a certain inventory of, let's say, $1 million. And what will happen is that when you deliver this to the customer, this inventory will be gone from your asset side, and what you will record is your account receivable. And let's say if you sold it for 1.2 million, then now you are showing a receivable of 1.2 million, and what will happen is, to your equity we will add this 0.2 million. So either way, your accounting state equation, which is assets is equal to liabilities plus equity, will always stay balanced. That if your assets of 1 million are becoming 1.2 million, so this additional 0.2 million will get added on this side as well, right? So even though the payment has not been received, you will show it as an asset account called accounts receivable. All right, another example. What if the advance payment is received in period 1 but goods are to be delivered in period 2? When will this revenue be recognized? And the answer, my friend, is that it will be recognized in period 2, because that advanced payment means nothing until you deliver the goods or you deliver the service. And until you do that, it's actually going to be a liability for you. So what will happen is that, let's say this customer gives you an advance payment of 1.2 million, which will go and get added. So this will obviously get added to your cash, right? So your cash has gone up by 1.2 million. You need to keep your accounting equation balanced, which means there is going to be a liability called unearned revenue, and that liability is going to go up. It is going to go up by 1.2 million. And only when you deliver that inventory, which is currently showing on your books as 1 million, when you deliver that inventory, then you will cross off this liability of 1.2. Now you might be thinking, my asset side is going down by 1, but my liability is going down by 1.2. Well, that of course we are going to adjust by making the equity go up by 0.2. So minus 1.2 and plus 0.2 will of course have that net effect of 1. But anyways, don't worry about all these accounting entries. What I want you to focus on is that when you will receive that cash of 1.2 million, you will record an unearned revenue liability of 1.2 million, and only when you actually deliver the goods in period 2, then you will record that revenue. Now see, remember in the last learning module we talked about the differences of IFRS and US GAAP, and we said US GAAP is rules based and IFRS is principle based, and I explained to you what is the difference between rules based and principle based, in which principle based is having more judgment provided to the accountants to use in order to decide how to apply the principle. Now, when we talk about revenue recognition, this is principle based, not just in IFRS, but even US GAAP. For benefit of the whole world, I told you that there is a convergence going on, right, between them. So that hasn't happened totally as yet in all areas, but in the area of revenue recognition, there is a certain convergence that is happening, and it is happening towards principle based, where what the accounting standards are saying is that, hey, try to understand the principle, which is the benefit of the product or service should be transferred to the customer. The ownership should be transferred to the customer. Now, the accounting standard doesn't want to go into too much nitty gritty. It just wants to give you a high level principle that try and figure out yourself that when is the appropriate time to recognize that revenue as an accountant. But as an analyst, we have to be very careful, because accountants might be recognizing revenue aggressively. We don't like aggressive revenue recognition. That actually the sales hasn't even happened and they are just recognizing the revenue to show higher profitability. We don't like it. So it's very important for us that we go into the financial statements notes and understand the details of how a company is recognizing its revenue. What is its exact policy? So as I told you that both IASB and FASB, and IASB is of course for IFRS and FASB is for US GAAP, and we talked about it in the previous learning module, that they are moving towards a convergence, and in terms of revenue recognition they have both agreed to take a principle based approach. Now what is the principle? And look at the beautiful statement starting from here till here with quotes. Now the core principle behind the converged standard is that revenue should be recognized, and here is the principle: depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in an exchange for those goods and services. So this is a high level principle statement that you have to figure out yourself, that have you delivered to the customer what they expect to be receiving for those goods or services, right? And that is the consideration against which you are asking for a payment, against which you are recognizing a revenue that, okay, you might get the payment in future, or you might have already gotten it in advance. But the point is, against this payment, what is the consideration you have given to the customer, and is it as per their expectation? So now how do we go about doing that? And there is a very nice 5-step process which begins with, okay, what is the understanding between you as the seller and the customer, right? Do you have a contract? And coming back to the simple example of me and you, where you're giving me your car, right? You're selling your car to me. What is the contract that we have? That what is the make? What is the model, right? How many hours or kilometers or miles has it been driven, right? How what is the condition of the engine or whatever, right? Whatever. The point is that there has to be a detailed contract which specifies exactly what is the transaction that is happening. And there could be multiple performance obligations. And I like to give the example of a telecommunication contract when we talk about multiple performance obligations. Let's say you are a company like Verizon, right? And for those of you who are not in the US, let's say if you're in the UK, you're probably more, or in the Europe, you probably know Vodafone, right? Or if you're in the Middle East area, Etisalat or Saudi Telecom, or if you're in India, Reliance, right? These are all telecommunication companies. Now, all of us are probably aware of these type of contracts, that these companies, they give you a phone, right? They give you a smartphone as well. And they also give, when you sign, let's say a 12-month contract, so you can get a smartphone in upfront. Even though you're not paying for the smartphone, you're just getting into a 12-month contract that I will pay, let's say $100 for the next 12 months each month, $100 per month for 12 months, and they give you the smartphone upfront. Now, the contract that you're having with them, there are multiple things over here. There could be multiple performance obligations. Number one, the smartphone, that this company is agreeing to give you the smartphone. They are also agreeing to give you for 12 months calling facility, maybe internet as well, so data as well, right? So calls plus data. Now the question is, how much of this $100 per month, which obviously you're going to pay for 12 months, so this total revenue of this contract is 1,200. But how much of this 1,200 is for the smartphone that the company is giving to you, right? How much is for the data they're going to provide you throughout the year, and how much is the minutes or the call time, right, that they are agreeing to provide to you. So first of all, you have to identify the contract. You have to identify the different performance obligations within that contract. You have to determine the transaction price of each of those performance obligations. Let's say the smartphone is actually worth $800, right? And the data is worth, let's say, $200, and the call time is worth another $200. So this is the total of $1,200. So you allocate the transaction price to each of the performance obligations, as we have done, and then finally you recognize the revenue as the entity satisfies the performance obligation, which means the minute they hand over this phone to you, the obligation for the smartphone sales is done. They've given you the phone, and that's it. So immediately, the minute you sign the contract, $800 revenue this company will recognize, because now you have agreed to buy this smartphone from them. You have agreed to pay $100 over the next 12 months, right? Which is a total of $1,200. And as far as 800 of those dollars is concerned, that is for selling you the smartphone, which they have delivered to you upon signing the contract, and you have started getting the benefit of that phone. So the consideration is there, and they will recognize the revenue, even though the payment you will be making over the course of the next 12 months. But the company, whether it is Verizon or Vodafone or Etisalat or Saudi Telecom or Reliance, they are going to most probably recognize the revenue, because the performance obligation will be considered completed. However, for the data and the call time, they are not going to record the entire revenue immediately. What they will do is they will take this $200 of data, they will divide it by 12 months, because this data and calls they are going to provide you for the whole of 12 months. And the calls as well, they are going to provide you for the whole of 12 months. So they will divide it by 12, and they will recognize that revenue once the service has been provided. So at the end of each month, once you have used the data for that month, once you have used the call time, and whether you have used or not, it might expire. But the point is that right to having, let's say, 10 GB monthly data or 100 minutes on network calls, right? Whether you use them or not, once the month passes, they will recognize the revenue of 200 divided by 12 and 200 divided by 12, and they will recognize it over the whole year like this. So this is basically revenue recognition. Now there is a lot more to this. This is just one example that I have given you. The curriculum gives a very, very nice detailed example, and we are going to go through that example together. So what's happening over here, again, with the discussion that we were having with respect to our assets, liabilities, and equity, that as soon as you will sign the contract, you will show accounts receivable. The company, let's say this is Verizon, right? And they will show an accounts receivable of $1,200. Well, not 1,200, 800 revenue they will recognize. So they will show that as accounts receivable, and slowly you will be paying them $100 every month, and this accounts receivable will be adjusted, right? As the data is used, they will keep adding the revenue for that. As the calls are used or the month is passing, they will keep adding to that to the account receivable. They're not going to add 1200 immediately. No, they're going to record the revenue as their performance obligation is completed, and then as you make the payment, the account receivable will go down and the cash will go up in the company. If you pay in advance but the performance obligations have not been met, so let's say you give the 1200 in advance for the whole year, right? So what the company will do, they cannot say, okay, my responsibility for the whole year has been completed, and they cannot record this 1200 in the sales. They will only record whatever has been completed by them. So let's say it's just the first month, so they will record 200 divided by 12 for the data, 200 divided by 12 for the calls, and 800 for the smartphone, and the remaining will be shown in unearned revenue, and it will be slowly earned over the next 12 months and 11 remaining months, and then transferred to the revenue account. So it will recognize revenue when it is able to satisfy the performance obligation by transferring control of the goods and services to the customer. In this case, it is the data and the calls service. Right, so what are the factors that consider the service or the product to have been delivered, or the consideration given to the customer where the customer has gained control? Customer should get legal title, right? They should have physical possession. And think about the car, that you've transferred the car to me, you've physically handed over the car to me. Risk and reward of the car has come to me. Now if there's an accident, it's my problem. I have accepted it, right, in the condition that you have given it to me, and you now have a right to get a payment from me. So once this is done, the seller can recognize the revenue. This is what is required to say that the performance obligation has been completed, right? But again, please keep in mind that this is a principle based accounting standard, so there is judgment possibility here.